Most retail investors are currently staring at the United States market and waiting for a signal that has already been flashed on the other side of the world. While you are focused on the daily volatility in New York, a massive liquidity vacuum is quietly forming in the Asian session that threatens to leave Western holders behind. The reality is that smart money is no longer waiting for permission from Washington. We are witnessing a structural decoupling of Bitcoin price action from American equities, and it is being driven by a sovereign-level shift toward Hong Kong. If you are holding Bitcoin right now and ignoring the regulatory arbitrage happening in the East, you are trading with one eye closed. In the next few minutes, I am going to walk you through the on-chain data and the geopolitical setup leading into Consensus Hong Kong 2026. I will provide the evidence that suggests the center of gravity for the entire digital asset market is permanently relocated. Let us get into the weeds. To understand why the Consensus Hong Kong 2026 event is not just a conference, but a market cycle definition, we have to look at the current state of liquidity. For the last 3 years, we have conditioned ourselves to believe that the Federal Reserve is the only entity that matters for Bitcoin price discovery. However, the 30-day moving average for exchange inflows during Asian trading hours has just hit a 3-year high. This is not a coincidence, and it is certainly not retail traders buying a few $100s worth of coins on their lunch break. This represents institutional accumulation that is being executed systematically to avoid slippage in Western markets. The reality is that capital flows like water, and it always seeks the path of least resistance. Right now, the United States is building a dam made of litigation and regulatory hostility. In stark contrast, Hong Kong is building a canal wide enough for sovereign wealth funds to navigate. When we look at the order books, we are seeing a thinning of sell walls during the European and American overlap, while buy support is thickening significantly during the Hong Kong Open. This matters because it signals a transfer of ownership from weak Western hands to strong Eastern hands. We saw a similar pattern in late 2020, just before the supply shock sent Bitcoin into a parabolic run. The difference this time is that the buyers are not just micro-strategy corporations or hedge funds. The buyers are state-backed entities and licensed institutions operating under the new Hong Kong Virtual Asset Framework. This framework is designed specifically to capture the capital fleeing the uncertainty of the United States. If this level of data analysis helps you clarify your long-term strategy, consider subscribing to stay aligned with the smart money movements. Let us dig deeper into the infrastructure that makes 2026 the critical target date. The narrative of Consensus Hong Kong is about the consensus of capital, not just a gathering of people. By 2026, the integration between the Hong Kong financial rails and the mainland Chinese economy will likely be fully realized. We are already seeing the pilot programs for the digital yuan and the cross-border Wealth Connect schemes. These are not isolated experiments. They are the plumbing for a new digital financial system that bypasses the traditional SWIFT network. Bitcoin and Ethereum are being positioned as the neutral reserve assets within this new ecosystem. The introduction of the spot Bitcoin exchange-traded fund in Hong Kong was just the opening move. Many analysts dismissed the initial volume of these funds because they compared them to the American launch. Here is why this matters and why that comparison is flawed. The American exchange-traded funds are primarily retail and wealth advisor products. The Hong Kong exchange-traded funds are structured to eventually allow for in-kind creation and redemption, which is a mechanism that appeals to massive holders and miners. Furthermore, the Hong Kong market is the gateway for the immense savings rate of the Asian populace. We are talking about trillions of dollars in household savings that are currently earning yield below the rate of real inflation. As we approach 2026, the regulatory clarity in Hong Kong will act as a green light for this capital to rotate into digital assets. The smart money is positioning itself now, years in advance, because they know that by the time the crowd arrives in 2026, the price will have already adjusted. The accumulation we are seeing on-chain is distinct because of the wallet sizes. We are tracking wallets that have been dormant for 3 to 4 years, suddenly waking up and moving assets into custody solutions based in the Asia-Pacific region. This is a defensive rotation. These large holders are hedging against the possibility that the United States continues to debase the dollar while simultaneously attacking the crypto industry. They are moving their chips to a table where the dealer has explicitly stated they want the game to continue. The shift to the East is also a shift in the type of utility that is driving value. In the West, the narrative is often about speculation and number-go-up technology. In the East, the focus is heavily on tokenization of real-world assets and payment utility. Hong Kong is positioning itself to be the global hub for tokenized bonds, real estate, and equity. Bitcoin serves as the pristine collateral underpinning this entire tokenized economy. Therefore, when we look toward Consensus 2026, we are looking at the maturity point of this tokenized infrastructure. The demand for Bitcoin will not just come from people wanting a store of value. It will come from institutions needing high-quality collateral to settle transactions on these new regulated networks. This structural demand is inelastic, meaning it does not care if the price is high or low. It needs the asset to function. If you are finding value in this deep dive, make sure you are part of our inner circle by hitting the notification bell so you never miss a critical update. Now, we must address the elephant in the room, which is the relationship between Hong Kong and mainland China. There is a misconception that China banned Bitcoin and therefore the East is bearish. The reality is that China banned private mining and retail speculation to stop capital flight and energy consumption issues. They never banned the ownership of Bitcoin as a virtual commodity for legal purposes. Hong Kong acts as the sandbox for China. It allows the mainland to interact with the global crypto market without opening its own capital borders fully. By 2026, we anticipate that the Southbound Connect mechanism will open up to allow eligible mainland investors to access Hong Kong digital asset products. This is the liquidity event of the decade. Imagine a scenario where even 1% of the Chinese equity market capital rotates into Bitcoin via Hong Kong. The supply shock would be mathematically impossible to suppress. Currently, the available supply of Bitcoin on exchanges is at a multi-year low. Miners are holding onto their inventory because their operational costs have increased, and they anticipate higher prices. When you combine a supply crunch with a new, massive source of demand from the East, the result is violent upside volatility. This is why the timeline of 2026 is so crucial. It represents the convergence of regulatory maturity, infrastructure readiness, and the inevitable opening of the capital floodgates. Those who are waiting for the United States Securities and Exchange Commission to provide clarity are fighting the last war. The next war for capital supremacy is being fought in Asia, and the victors are already accumulating. We are also seeing a divergence in the derivatives market. Open interest on Asian-based exchanges is growing faster than on their Western counterparts. This indicates that the speculative fervor and the hedging activities are migrating. Traders in the East are becoming the dominant force in setting the price at the margins. If you look at the heat maps of liquidation levels, the clusters are forming around price points that are significant to the Asian technical analysis setups. This creates a self-fulfilling prophecy, where the market moves to respect the levels that the dominant volume is watching. So, what is the playbook for the individual investor in this environment? First, you must divorce your sentiment from the American news cycle. Headlines about American politicians fighting over crypto regulation are becoming less relevant to the global price action. Second, you need to watch the flows into the Hong Kong exchange-traded funds and the volume data during the Asian Open. These are your leading indicators. Third, you must understand that this is a long-term thesis. We are positioning for 2026, not next week. The volatility between now and then is simply noise designed to shake you out of your position. The transfer of wealth from the impatient to the patient is an old adage. But in this specific context, it is a transfer of wealth from the Western skeptic to the Eastern believer. The East understands that Bitcoin is not just a stock. It is a supranational monetary network. They are building the rails to control the on-ramps and off-ramps of this network. By the time the Consensus Conference in 2026 takes place, the narrative will have shifted from adoption to dominance. You have the opportunity now to front-run this realization. Do not let the quiet accumulation fool you into thinking nothing is happening. The water is rising, and it is rising in the East. To summarize the strategy moving forward, focus on the accumulation data coming out of Asian custody providers. Ignore the fear, uncertainty, and doubt generated by Western regulatory bodies. Recognize that Hong Kong is the proxy for the largest capital pool in the world entering this market. And finally, ensure that your time horizon aligns with the structural shift that is taking place over the next 2 to 3 years. This is not financial advice. This is an observation of market mechanics and geopolitical capital flows. I am a market strategist analyzing the data as it appears on the chain and in the order books. Trading cryptocurrencies involves a significant risk of loss and is not suitable for every investor. Do your own due diligence and never invest money that you cannot afford to lose. The shift is happening, and the data is clear for those willing to look.